Hi everyone, welcome to the live stream. It is Friday morning. Market is just getting thing rolling, and so are we. This is a change from previous weeks, of course. I'm getting my sharing set up now. This is something different. We're changing up the time to try to accommodate some things with my family. So we're getting started here, even as the market is getting rolling. Actually, kind of excited. This will change the dynamic just a little bit of some of the positions that we're looking at. Instead of being a couple of hours into the market, we're catching things just as the market is getting started, and that'll be kind of fun. Looking forward to seeing how that plays out. Really quickly, just by way of a couple of housekeeping items. Number one, if you want to contact me for any reason during the week in between live streams, you can do it a couple of different ways. One way is by sending me an email, and I've just dropped my email address into the chat. And that's rebelincomesystem@gmail.com. Please feel free to contact me that way. I'll respond as soon as I can. If you are on Discord, you can also reach out to me directly there. You can send a direct message to anybody that you are connected to, any other servers that you are subscribed to, just by clicking on direct messages up here and then selecting the person that you want to message. So you can certainly do it there. Another area just for the people that are subscribed to the server, and those of you who are subscribed to Plus Access on my Discord server, is the open discussion channel. This is an area that I've set up specifically to try to get some conversation going in the community. This is where you can connect with other people and talk about what's going on in the markets. You can also message me as well. This is probably where I can be the most responsive for those of you who are in Discord, because I do pay attention to this throughout the day, and will try to respond just as soon as I can. Jay had a comment earlier this week, for example, about put sale on Skyworks, and so that was nice to see that. So feel free to use that. Those of you who are subscribing on Substack, another option that you have. Let me switch over here. You can reach out to me a couple of different ways. One is right here through chat. You can click here on Rebel Income, and you can message me right here as well. So that is also available, just as with the open discussion forum on just as with the open discussion channel on Discord. You can use that chat function in Substack to message me. And again, that's something I'll get notified about. I'll be able to respond. Really, between Discord or Substack, those are probably the fastest ways that I'll be able to respond to questions that you have. Okay. With that said, one of the reasons that I always like to do this live stream on Friday is so that we have an opportunity to look at some of the different trades that I've been highlighting and that I'm following, not only in real time, but as expiration dates are coming up. Rebel Income is really focused around selling very short-term expirations on the options that we work with, whether we're talking about a put sale, a covered call, or a bull put spread. We're usually trying to work with expirations of a month or less. That means that price dynamics are certainly a major consideration for some of the adjustments that you may decide to make over the while you have a trade open. More important, and in many cases, a more dramatic impact comes from the effective time decay. And so paying attention to this on Fridays as we're hitting weekly expirations in many cases, offers a really nice opportunity to evaluate some of the open positions that we have and to evaluate if there are some changes that need to be made. All right, so with that said, I'm going to go ahead and just start with what we do have on deck for today, and that's just one position. That is a covered call on CVS. Now, to be clear, and just in the interest of full disclosure here, CVS is a stock that I've held for quite a few months here. I was assigned back in November of last year at $64. And so this covered call, I sold the 65. This was the last week of February when I placed this trade, brought in about 1.84% for about a 2-week trade. This is a really, really good example of one of the things that I really like about being an income generator, focusing on the selling side of options, is that sometimes you do take assignments. You're going to have to figure out what you're going to do with those stocks when that happens. I like that. I look at put selling as a gateway to stock ownership because it offers opportunities to leverage that stock, not just to try to wait for it to go up in price, but also to leverage opportunities to generate additional income with covered calls. We can see here on CVS, I've had a couple of opportunities to generate covered calls on this one. It took a little while because the stock dropped below my assignment price for a while, but I had a nice one in the middle of February that only lasted for about a week. I brought in a little over 2% on that one. And then this current covered call that is set to expire today. So let's go ahead and switch over here and take a look at how CVS is doing. And again, I sold the $65 strike price. So far as the market has just opened up, it looks like we're a little bit above 65. Certainly got a few hours to go yet in the trading day, and so this could change. We'll see if that continues to hold. But we've got a really interesting consolidation range developing for CVS right now. Got a pretty solid resistance up here. What's this about? Probably $67, maybe 66 and change on the top end, and on the low end, pretty strong support right around 64 where I was assigned. So all things being equal, it looks like I'm going to get called out on this. That means not only that I'm going to sell my shares, but also that I'll make the difference between 64 and 65. That's a nice little trade, and it'll be nice to book some profit along with the income that I brought in from the covered call. Just to kind of put the overall result in perspective, let's go ahead here, and I'm going to CVS. Well, I can do better than that. We'll type it here. Assignment came at 64. Income trades. On this, we had quite a few. So we'll start with the initial assignment here in November of last year at 64. This was a put sale that generated $1.15 in income. Excuse me. $11/20/24 is when that trade happened. And then we also had this covered call in February. Again, that was a 1-week trade. Selling the 66, that expired. The stock was a little bit below 64 when that expired, but that brought in another $1.46 in income, which, again, that's a nice result. And then this current covered call is right here at $1.18. And this is, I'm just going to go ahead and put 3/2025, even though technically it was placed on the last day of February. So that means that the sum total of all of these, all of the premiums brought in, and I'm going to need to switch here for a second. Let's pull up the calculator. There we go. It's $1.15. I'm not going to try to do this math in my head because that never works out. So $3.79 in total premiums. And if we think about that against the $64 assignment, that's about 6% in return since having taken that assignment in November. So about 5 months, making about 6% just from the covered calls. That's actually pretty nice. $3.79 for a total yield. I'll put premium yield here. 5.92%. Now another element here that's worth talking about for a moment is dividends. And in the case of CVS and having taken this assignment in November, that meant that I was able to bring in this dividend from January. This was 66.5 cents. Again, that might not look like a lot, but that's on an annualized basis pretty nice on a $64 stock. CVS is paying a very attractive dividend. And so that means 0.665. When I add that to my 379, $4.45, 45.5 if you want to split hairs. We divide that by 64 again. Almost 7%, and that's just in terms of income. This was for roughly about 4 months of time. Maybe a little bit over that, but still 4 months. You annualize that, you're talking about 21% roughly just in terms of overall return there. Now we add in the $1 capital gain, assuming I am called out, of course. Now the total return would be $5 and $4.55, or a little over 8.5% for the same 4-month period. Now you're talking about something in the neighborhood of about 25% per year. That's actually a pretty fantastic result, at least as far as what I'm looking for. For my income trades, I'm really looking for an average return of about 1.5% per month in terms of the income that I can generate. And anything over that is really gravy. That's just kind of extra. And so this is a very nice result from CVS, all told. Again, this is making the assumption that I'm going to get called out. There's a lot of activity that's got to go on still throughout the rest of the day. So this is not a given. It is entirely possible. Stock is now pushing up a little bit towards 66. It is still possible that the stock could drop back below 65. If it does, I'm still going to hold on to my shares. And again, I'm okay with that. If we go back here and just look at the support that we have right around 64, with that holding in place in a pretty steady fashion right now, I would not be all of that upset if the stock did drop below 65. It would probably give me another opportunity to go ahead and sell another covered call. But I'm also okay with getting called out, and so we'll see ultimately where this lands. But so far, it looks like we're in pretty good shape, and that's a good result when we're talking about the kinds of trades that I like to place with Rebel Income. I start by selling a put option on that to generate some of that initial income, and for CVS, that initial put sale brought in a little over 1.8% for 2 weeks, and so that was just by itself was a very, very nice trade, and since then been able to generate enough income on that to make this a very, very productive position. That's why one of the reasons why I'm okay being called out. That'll free up the capital that I put into the trade. Now I'm only in on one contract, so the total amount that I have reserved is 65 times 100 shares. So that's $6,500. That's a relatively modest reserve requirement. Whether you have that in cash or in margin, depending on the nature of account that you're working with. I try to work as much as I can on a cash secured basis and not have to dip into margin in order to place these trades. That means that I am trying to be intentionally very, very conservative about the trades that I'm placing and the position sizes that I'm using. I think that given the way that the market has been behaving, especially in the last month, that being very careful and cautious and conservative about your position sizing is really, really important. Market is up a little bit today, but we've been seeing really over the last month a significant increase in bearish pressure. And in fact, this is far enough that the S&P 500 is about 10% below its the last all-time high that we saw in February. So we are in legitimate correction territory right now. And that's got a lot of people kind of nervous. Corrections tend to wash out a lot of speculators, and that's why they're not always categorically bad. However, they do start the conversation going about whether or not there's more serious times ahead and whether or not the correction could accelerate into an actual bear market. You remember, corrections can go anywhere from 10% to about 20%. Now, to get down to a 20% decline from the current level that we're at, we're really talking about getting down into this range, maybe even a little bit below that. So we've got a long ways to go before we're talking about anything close to a bear market. But this is steep enough and far enough that it raises a level of concern, alarm, even if you want to use that word, about how much risk in the market there may actually be. And this is one of the reasons why, when it comes to placing new trades, a lot of people in these kind of conditions, they just want to, they kind of want to sit on their hands and not do anything. And I understand that, believe me. And that's not necessarily the worst idea, because it does mean that you're simply waiting for the market to hopefully stabilize, begin to consolidate, and set up a new, better opportunity, hopefully at lower prices. At the same time, there's a lot of opportunities, even in a bear market, to place really, really, really good trades, especially when we're talking about being able to generate income. There's a lot of money that is just waiting to be picked up. I talk about the low-hanging fruit in the market a lot, and in conditions like this, there's a lot more of it available. That doesn't mean that I start to increase my position size or trying to place more trades. It just means that there are opportunities to be had. You just have to be cautious. You have to be very selective. This is why I put such a premium on the fundamental and valuation analysis that I do, is to try to make sure that there's a very, very strong value proposition in place, backed by a very, very healthy set of fundamentals. But if those are in place, there's no reason not to go ahead and place a trade. But this is certainly one of these situations where we want to try to be cautious. It's possible. I will, if you want to take a little bit of a bullish viewpoint right now, it is possible that we may see the market begin to stabilize here around this 5,500 level. Excuse me. I'm stuttering a little bit, and I don't mean to. If it does, then this is going to be the kind of a move that moderates the overall longer trends a little bit, forces, for example, the 200-day moving average, which is I use for the long-term trend. It'll force this to shift a little bit, and the slope will moderate. That's not a terrible thing. That actually would, in all likelihood, make the long-term trend more sustainable, assuming that we do see that stabilization and a rebound back up here. Now, if we see the market drop, if we see the market push below this level and extend itself, then we really have to be, we're going to continue to look for new levels of consolidation or stabilization between where we are now and this 20% mark. But this is, again, going to be an area where we want to be really careful, be very deliberate and cautious about not only when we take a new trade, but also how much money you put into any new trade. I am being very conservative. I showed you some of the position sizes that I have right now. I'm trying to limit my position size to no more than 2% on any one trade right now. CVS, as an example, at 6,500. My account is about 295,000 right now. Was a little over that, so so I'm a little bit over that 2% threshold with CVS. 2.5% is the top end top end level that I'm willing to accept right now. If I can go below 2%, I can actually be between 1 and 2%. Then I'm in a much more comfortable place right now. When the market is clearly bearish, you can think about expanding those position sizes a little bit. I tend to prefer to stay on the conservative side. Even in very bullish conditions, I'll try to stay between 2 and 3% in most cases. All right. So that's a little bit of a soapbox about the broad market. Thanks for bearing with me on that. And let's go ahead and take a look at some of the other things that we have on deck. Next week, there's a number of trades that are set for expiration. Let's start with this put sale on FMC. This is a stock in the materials sector that I've paid attention to for the last few months. This is a really interesting company focusing on fertilizers and phosphates, those kinds of things. On this trade, I set this up. This was just a little bit over a 1 month trade. Selling the 37.50 strike price, bringing in about $1.40. That's a very not normal result, I should say, of 3.73% on that one. Now, this is one we're still a week away from expiration. So depending on where the stock is, there may be some room to make some adjustments. We'll see where this is. Okay, FMC sold 37.50. And so on this one, there's this great big gap that happened right here. And that's actually what opened up the opportunity for the put sale, which was right around the strike price that I sold is right about here. And we can see that the stock has picked up a lot of bullish momentum right now. Is at 41.40. Now that's about $4 away from the strike price that I sold. That offers an interesting opportunity to think about whether or not to close out this trade early. So let's go ahead and check in on FMC. There we go. Take just a minute here to load up, but there we go. Take a look at the options on this. Got a little bit of a lag here in the feed. Let's try to there we go. All right. So FMC, this is a stock that does not offer weekly options. And so you only have really a very limited opportunities, I should say, when you're looking at put selling opportunities with this. It's also got about a $2.50 difference between strike prices rather than what we see with a lot of stocks, especially those with monthly expirations that often offer $1 increments. We're going with $2.50 per on this one. So what that means is that if we wanted to close out this trade early, remember, I brought in $1.40 on this in income. And I could buy this back right now for 15 cents. That means there's an opportunity with 7 days left. Well, hold on. That just refreshed, didn't it? Let's see what this is at. Okay. That ask just went really outsized. That's not cool. I'll just go with the last trade here, which was at 11 cents. Go ahead and call that 15 just for the sake of argument. That's where it was right before the screen refreshed. But if I were to put in an asking price on this of 15 cents, I might have to wait for the market to come back to some rationale right here right now, considering that it's wanting $2.20 on this. But assuming I got the 15 cents, that would mean that I'd hang on to $1.25 of the premium that I brought in. I would also eliminate the reserve requirement with 7 days of extra time. And so I'd have $1.25, divide that by 37.50, and I'd still be at 3.33% net return for about a 21-day trade as opposed to the full month, which is what I'll be doing just by letting it go ahead and work itself out over the course of the next week. By holding it an extra week, I am running a little bit of a different risk. The stock could lose some of this bullish momentum that it's seen, and it could drop back down into the range where I was where my strike price sits. I could be assigned still, but it's looking like it's setting up some nice momentum here. Now, if you did decide to buy that back, a lot of the people that I work with in Rebel Income that tend to be a little bit more active about the way that they manage these trades. I like to call them rollers. This is something that they'll consider doing, especially if they can hang on to at least 50% of the premium they brought in when they sold the put option in the first place. And that offers an opportunity. Once you've bought it back, the reserve requirement is immediately removed. And rather than waiting a couple of days for trade settlement, the capital that you had used to reserve this position can immediately be deployed in a new trade, whether that's with the same stock or with something else. If you like the stock, and I do in the case of FMC, that means that you can consider whether or not to keep working at the same strike price, or whether or not you want to possibly move with the market. In the case of FMC right now, that means that you could think about selling the $40 strike price for a little bit more than a month. You can bring in another $1.40 right now, so about another 3.78%. Well, I take that back. It'd be a little bit over, be about 2.5%. But that's still pretty nice for just about 1 month. And the stock right now is, 41.49. It's about $1.50 away from that price. So this is out of the money. That's actually a little bit more conservative than it looks because of that distance. If you wanted to be even more conservative and go to 37.50, this is also very interesting to me. Now, keep in mind, I'm not making any kind of recommendations here on the kinds of trades you should be placing. I'm just offering choices. That's a 1.6% result for 34 days, call it 1 month. That is well within the 1.5% target that I'm looking for, and this is still very, very conservative. You're about $4 out of the money on this one, and so the interesting thing about FMC right now is that you've got implied volatility on this is pretty high, and a lot of that is coming from the increased volatility in the marketplace right now, and that's elevating, that's inflating the option premiums a little bit, which is not the worst thing. My normal method here, and what I'm going to continue to do with FMC, is the same thing that I do with all of my put sales, and that's to let the option. I'm going to hold it through expiration. If I take the assignment, I take the assignment. But here's some other things you can do if you want to take a little bit different approach. than what you see me work with in the trades that I highlight. Okay, so that is FMC. There's also a covered call on Devon Energy, DVN, coming up on the 21st. Need to go back to GIS. I'll do that in just a minute. But here's one on DVN. I was assigned back here at the beginning of November at 39.50. And this covered call is at 40 cents. So there's an opportunity here, hopefully, to bring in a little bit of capital gain on this. About a week left. This was a 1 month trade, brought in about 70 cents or about 1.77%. So let's check in with Devon really quickly. And this is a stock that's picked up some bearish momentum here from this peak. A little bit above 38, showing some nice momentum starting to rally. It's dropped back again and is now at just a little bit below $34. So this is going to expire on all likelihood. It could, of course, in the next week pick up a lot of bullish momentum and possibly push above 40. I don't expect so. Not with that resistance at around 38, maybe a little bit above. And I'm okay with that. This is a good company, and I'm willing to ride this out a little bit. It's below my strike price by a bit, and for some people that's kind of a scary thing. As long as the value proposition is above the is well above the price that I'm assigned at, I'm willing to ride through these trends, and so that doesn't cause me a lot of angst. So we'll see where that one lands, but certainly right now it looks like I'm going to be hanging on to the shares. Let's go back here. I did skip this put sale on General Mills. This is another one. I went out a little bit more than 1 month on this trade. This was placed back in February at 57.50, bringing in about 2.43%, $1.40 per share. So 57.50 was the strike price. And selling a little bit over a month gives the stock more time to see some movement, and certainly in the case of General Mills, saw a big push here. Topped out at about about 65.50, and has dropped back since then. Right now it's sitting just a little bit below 60. And my strike price is right about here. So there's still some room. And if it can stabilize a bit here, it looks like that should probably be okay. And it'll expire worthless. At the same time, with it starting to bounce a little bit and still above the strike price that I sold, we do have another opportunity in this case to think about whether or not to buy it back. So again, just for reference, remember I brought in $1.40 on this one. At 57.50. This is another stock that doesn't offer weekly options. And in all honesty, with the way the bearish momentum has been increasing, it's not all that surprising to see that if I wanted to buy this back, I'd have to pay 95 cents per share right now, which means I'd hang on to about 45 cents of the premium that I brought in. That's less than 50%, which is not ideal. So I'd rather let this play out. But if you are the type of person, and we do have some of our income generators who do not want to take assignments, and that's perfectly fair, then sometimes if you are worried about bearish momentum picking up to the point where you could be assigned, sometimes it's better to go ahead and book even a small profit, minimize your exposure, move on to something else. In my case, I'm not afraid of this. I sold the put option with the understanding I could be assigned at 57.50, and I decided that I was okay with that if I am. So I'm going to continue to hold it and see how that works out. If I get assigned, I get assigned. If I don't, then that's fine. All right. That's General Mills. So we did DVN. Then we have this week's put sale on Skyworks. Again, this is just placed on Wednesday. I brought in $1.25 on this for about a 9-day trade. That was actually pretty nice, bringing about 1.85% for 9 days. That's a very, very nice result. Let's selling the 67.50 strike price. Let's see where this is at now. Going a little bit below 69. So we're saw some a nice little bit of stabilization and a pivot low at this point, and we're bouncing a little bit higher, which is nice to see. Still some time to expiration on this, about a week. So let's go ahead and check in. It'd be interesting to see where this is in relation to $1.25 is what I brought in, 67.50. And again, if I wanted to buy this back, $1.05, hang on to only about 20%. So no reason not to let this extend itself and let time decay really start to work on this. And that's kind of the point of selling shorter expirations, is to leverage that time decay element and let that really play out. So we'll see how this goes. But that's kind of where this one sits right now. Just a couple of days in, and it's moving pretty nicely. The other put sale that I have is on gold. This was placed last week. And in full transparency, this is a trade that I placed on a stock that I already have shares in at a higher price. And so by selling the 1750 strike, this was a good opportunity for those who didn't have a position in Barrick Gold already. For me, this was also an opportunity to possibly, if I do take an assignment, to average my cost in the stock a little bit lower. But this is very functional. This was about a 3-week trade. This is still 2 weeks from expiration. Brought in 31 cents per share on a 1750 strike price, which is about 1.77%. And one of the reasons that was a nice trade is because of the way that the market has been volatile. When people are starting to worry about things like recession and inflation, then precious metals tend to be kind of a safe haven that people kind of flee to. That means that mining stocks, for example, that deal with precious metals, often kind of act as proxies for the precious metal itself. And so you'll see these stocks rally in a lot of cases. That's why that this trade at 1750 was pretty useful, and looks like it's in a good position now, but we are still a couple of weeks from expiration. That means, especially given the way the market has been volatile lately, that again, I brought in 31 cents. We can see how this is looking right now. I'll be a little bit surprised, to be honest, if there's an opportunity to roll it. Let's go out to the 28th, 1750. So this is interesting. You could buy this back for about 11 cents right now. Hang on to 20 cents of the premium that I brought in, so a little over 50% on that. And then if I wanted to continue to work with the same stock, I could even stick with the same expiration, move up and sell 1850 for 29 cents for 2 weeks, bringing in about that's going to be about 1.5%. I'm talking off the top of my head, so let's double check. 0.29 divided by 1850. Yeah, 1.56%. That's not terrible for 14 days. Not a recommendation, obviously, but something to think about. I like the trade that I've got down here at 1750. It's more conservative. I'll let this thing play out and see where that one lands as well. All right. Also have a covered call set for next week on CTRA. This is a stock that I was assigned at 27 on last year. I've held this for some time, and started to pick up enough momentum to give me a good covered call trade this week. Right now, it's still a little bit below 27.50. So we'll see if it continues to rally enough to call me out. If not, I've been able to sit in it for a little while, and this is a good company that pays a decent dividend, and so this has been a productive position. If I end up hanging on to it, I'll just look for another opportunity to sell another covered call, and that's perfectly okay as well. All right. The only other position that I have here is a covered call on Halliburton. This is a stock that I took an assignment on last week at $26, and I sold exactly the same strike price. So this is also a trade that is out a little bit more than a month. I brought in about 2.69% on it, but by selling the $26 strike price, that means that this 70-cent premium is, if I get called out of this trade, this is the entire gain. This is my entire result from Halliburton. As of now, it's sitting at around 24.69. So we're actually a little bit below that mark. We'll see. This is one of the reasons I wanted to give this a month to play out, was to see if it's got enough. See if it can build some momentum. We saw a pretty good pivot low off of this bottom at around 23.50, and it built some initial momentum this way. It's tracing back since then, but if this can start to develop into a potentially new short-term trend, it could push up here to 26. If not, I'll hang on to it again a little bit longer, and I'll just keep the income generation going. But this was a trade that was a little bit outside the norm for me, but again, in the vein of picking up the low-hanging fruit of the market. 2.69% for just a little over 1 month is a good result, and that was pretty attractive. So decided to go ahead and do that. All right. That's all of the currently open positions that I'm looking at, that I'm paying attention to. I hope that reviewing these has been useful for you. Again, I know that the shift to an earlier time is a little bit of an adjustment for a lot of you who are usually regulars on this live stream. So I hope to see you again in the weeks ahead. If you do have any questions between now and then, don't hesitate to let me know. As always, reach out to me, email, on Discord, on Substack, however you need to do it. Don't hesitate to let me know. I'll respond as soon as I can. Thanks, everybody. Appreciate your time. Hope you have a great weekend. See ya.